Hey everybody, welcome to this webinar. Welcome to this webinar on the OMICRON Effect. I'm Shane Smoleny from Wolftrader Futures, and we're going to be talking today about how Omicron is going to affect markets, how I see the outlook on the different financial markets, political factors, economic factors. So this is kind of a broad-based overview of Omicron and how I think it will affect the markets. Just a couple of notes. Today we went a little bit earlier. We will be going earlier uh, probably next week. We'll probably go early again on a Sunday because of the holiday schedule. Things are a little bit strange. And then the week after that, there won't be a webinar. So just to let you know that. So if you're planning on tuning in, just for the next couple of weeks, things are going to be a little bit off schedule, but we plan to get back to the 1 o'clock if we can on the Saturdays. So I want to stick to that time so everybody can be used to it. I know this is a different time. This is just a different uh, audience. You know, some people on the West Coast can't wake up this early, so you can always watch this on replay if you want to. So contact info. If you guys need to get a hold of me, you can reach me at shane@wolftraderfutures.com, or you can reach me at www.wolftraderfutures.com or www.fedjuice.com. The YouTube channel, which is what you're watching now, is Wolftrader Futures, and the Twitter is at WolftraderFUTU1. And so you can check it out there. Just an overview of our services here. We have multiple services that we offer. We have S&P, metals, energy, currency, cryptocurrencies. These are all newsletters, and these all have daily Fed juices posted in addition to the double lunar cycles. We have grains and financials are coming. So that's something that has been existed in the has existed in the gold membership for years, but we are going to actually add it to the actual newsletter soon. So if we take a look down here, you can also see that we have a Uranium Newsletter and the Stock ETF service. Stock ETF service is dealing with stocks and ETFs. The only ETF we have on there right now is gold miners, but we're dealing with a lot of other tech names like Tesla, Broadcom. We have Caterpillar, Bank of America. So we do have the volatility index, the VIXY, which I will be talking about today. All of this is the gold membership. So anytime we add new services or features, if you're a gold member, you automatically get that. So this is a grandfathered concept. So each time you sign up, it pays to stick around because as we add more services, you get those services and then your lifetime rate locks. So if you're interested in any of these services, as the services expand across time and as the technology increases, you automatically get those. Platinum membership is everything in the gold, plus you get a live Twitter feed. We have trading services, option spreads, the fast fed big runs, which is doing outstanding. Easy timer, pairs trader, which is going to be replaced with the portfolio trader, which we'll get into. I'm getting into creating portfolios out of all of our systems. Now, that's a different way to look at the market than most people do, especially short-term traders. Most people are looking to set up short swing trades, but the concept of the portfolio is that you're always going to be combining multiple systems and you're always going to be in the market. So, disclaimer, before we start out, just to understand that this trading commodity futures involves a substantial amount of risk. So you guys know that, but I just want to point that out here. Again, I have to say this all the time. Past performances are not necessarily indicative of future results, but I will say that the past performances that we post here are all published systems. These are all published, public record on Twitter, in the newsletters. So that's the one thing I will say. But just because they've been doing well doesn't mean they will continue to do well. I think they will, but there's no guarantee. This is designed to be an educational service as a supplement to the book I wrote with Larry Pesavento, A Trader's Guide to Financial Astrology. This is a book that's an introduction to financial astrology. So some of you may not understand what that is or how could that possibly affect the markets. But really, if you understand planetary action, you're really looking at cycles, just different time cycles and mathematical relationships and as they add up. So this book gives you the introduction. It does go deeper than that, but just as a nutshell, that might help you understand it a little better. I do have a firm, Trading Ridge Analytics. I'm a registered CTA and CPO. That's separate from what we do here. This is really just an educational service to help you guys understand how these things like the Fed and the planetary cycles and how these different trading systems can blend together to give you a smoothed out portfolio across time to get a nice return. That's the whole point about this. The data used in the creation of astrology, the data the data used in the creation of this is public record, so everybody gets it at the same time. Like, I don't get a call from Joe on the phone and tell him one thing and call Sally on the phone and tell her something else. Everybody gets it because this is a newsletter, and newsletters are just, it's a blast. Everybody, like, it's a blast in the sense, yeah, we have a good time, but it's a blast in the sense that I send it out to everybody at the same time. I don't give individual advice. I do interact with you guys on Twitter or the YouTube stream here, but for the most part, it's just everybody gets the same thing all the time. I don't know anything about your financial situation. You guys are doing your own thing. Most of you are very experienced traders to begin with. So uh, this is really important. Warning about using fragments. Be very careful about just looking week to week in terms of what's going on. Now, we have had a period here for a few weeks where it's always been kind of the same theme over and over again, down, 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 S&P, but that's going to change. I think it will change relatively soon. And so it's very important to get the day-to-day updates because that's going to fluctuate. In the S&P service, I'm looking into putting some type of a swing service in there too. So be careful about just tuning in on the weekend and saying, oh, I saw what it was on the weekend. That's what it is. It may change day to day. So be careful about that. Just because something's been going one way for a few weeks doesn't mean that's what's going to happen. Okay, so Fed information can change from day to day. We've seen this before. We saw the Powell pivot before. This stuff happens, and what we're seeing now in September, October is unprecedented in terms of the day-to-day action of the Fed. So you're going to get gaps in the information that you get. So I'm just telling you, be careful. You may hear something, may see a tweet. We're in a position. We could have been out of that position if you're not a subscriber. You may not even know that. Okay, so just be careful about that. I want you to understand that just because something goes one way for a few weeks doesn't mean it can't start going back and forth in the weeks to come. Profit graph history. So all of these profit graphs, these are actual published signals to subscribers. None of this is back tests or it's not like that. This is everything that I'm going to show you today is posted in the newsletter and on Twitter. So Twitter is beautiful because it's actually a timestamp. You can go through the history and search all of this stuff. So again, this is all documented and timestamped. So I just want to point that out. Terms of service, I never sell your personal data. I never share your personal data. I never buy personal data. So everything we do here is organic. And I prefer to work in smaller groups to start out instead of just trying to blast and get into all these email lists and all the spam and all the stuff like a lot of other services do. I kind of work on a one-to-one level in terms of starting small, like not trying, like if you sign up, you show interest, then I respond like that, like one-to-one like that, not like I'm just spamming out or I'm not giving out your information to other people. You have to physically sign up. So one-to-one in the sense that you signed up, you volunteered, you can unsubscribe at any time. My main terms of service here is that you understand the risk involved because this is risky. Futures are especially risky. You can end up owing more money than in your account. So be careful about that. Okay. So let's talk about some news and events here. So first of all, I will be on Trade What You See Monday, 12/6/21. So that's coming up. I'll probably talk a lot about what we talk about today. I might expand it out a little bit more. I always try to do something a little bit different in each webinar. Lately, we've been really focusing on the S&P and forecasting, but that's going to change. The next few weeks, I'm going to talk more about technicals and how the service works and walking you through the website, things like that. So we try to keep variety here, and lately we've been hammering the S&P on this, but we're going to change it up a little bit. So it's going to be more technical issues coming up in the weeks ahead. So if you like technical stuff, you're going to like the next few weeks because we're going to go into all the little details of the site and how to use the service and things like that, how to navigate. Next week, again, the webinar is going to be on a Sunday, so not Saturday, Sunday. So just be aware of that. We'll get back to our regular schedule, and then the week after that, there's no webinar. So it's kind of a change of schedule here for the next few weeks, but we will get back to that. Solar cycles are posted for the next 4 months. That's online. So if you're a gold member, you can get all of these solar cycle dates forecasted out for months ahead. So you can know what's going to happen. You also get the yearly update too there. Crypto, we have streaming crypto. In general, it's more accurate, but crypto does have limited price history to begin with. Cardano, we have Fed use and day percent statistics. Okay, so the hottest cycles. So this is important because the hottest cycles are going to focus on what is doing well right now. What cycle is particularly hot? And so I use a heat map to figure this out. So we have it for S&P, gold, and Bitcoin. So far, they're following all of these heat maps. This has been a very successful addition to the services. It's kind of a medium to long term. I got a question here. Next Sunday at 1 o'clock p.m. Probably 1 o'clock, Ron. Probably. I'll let you know. I got to check the schedule on that. But probably 1 o'clock p.m. will be good on next Sunday, just to let you guys know. So I'll double check. I'll get back with you guys on that. But if you guys are just joining us, I'm Shane Smoleny from Wolftrader Futures, and we are talking about Omicron today. Sounds like a transformer, right? Like Autobot or Decepticon. Sounds like something from a cartoon, like Omicron, like the villain, right? But that's what we're going to talk about today. So Omicron. I don't know how they come up with these names, man. It's like something out of a comic book or something. Um, anyway, so the heat maps have been doing really well. So yeah, I'm going to expand this out. So we're going to have it out into probably gold, silver, copper, Bitcoin, Cardano, all this stuff. The heat maps are going to show up. But so far so good, like really, really good. Very, very nice forecast here. I'm very happy with that. New closing bell is available. If you're a gold member, I do have it for grains and financials. So that is good. That's expanding out. The grains right now, we just have corn. I'm probably going to add soy to that, maybe wheat. Now, the thing about wheat is, here's the thing about wheat. Wheat gives the best signals, but it's light volume. The market moves a lot around on it. So, um, you know, corn is a very high volume market, but wheat's a little bit darty sometimes, but it gives the best signals. So maybe we'll put wheat into there. And then the financials, I have the 10-year note, probably going to put the 30-year bond on there. Uh, yeah, so that's all coming. The big runs. It's been kind of quiet. It had a little quiet period. It had all those huge gains we saw right before the holidays. It's in a trade right now. There's another trade coming Sunday night. So for those of you who are platinum members, um, you know that you know what these trades are. So, hey, Alan, what's up? We have Alan from Nebraska on here in the chat today. Um, so anyway, so these big runs trades have been doing really, really well. Um, we are taking out the profit gains for the year. So they're just rising and rising. It's been a very good tweak. We started this out with the FastFed 2.7 a while ago, like last year, and then we've gone through all of these different iterations, and we've come up to the big runs. And the big runs is really what this is going to be the end all be all in terms of the platinum service. This is what it's all about. Um, this is if you like swing trades and you like targets and stops, this is what it is. These are classical swing trades with defined risk and targets, as is the easy timer. But easy timer is like tiny trades. This is like 2 or 3 a week long trade type of a stuff. So there's another trade Sunday night. So I'll kind of keep you guys updated on that as we go. But uh, so far so good. Like I'm really pleased with the way that this looks. Streaming RSI. Oh, so this is new. So before I was putting the RSI on the actual closing bell. So if you loaded the closing bell, you saw a column there that said RSI and all that. But what I'm going to do now is I have a streaming way to look at this. So I'm going to put a snapshot of the streaming RSI so you can get an update and a timestamp of when that occurred. So it's very impressive. For those of you who are gold or platinum members, you guys see this every day. But we can get a really good bird's eye view. I was able to locate that low on gold like Thursday. I put out a video about that because it was sitting. One of the things I was looking at was the RSI was sitting at the bottom. The gold miners was sitting at the bottom and the gold was sitting at the bottom. And so we had that rising Fed juice. I sent out a video on that, but this list really helped me see that because you could kind of see them all stacked up together. All right, so portfolio manager, this is the next big thing coming. Now, you're going to have to change the way you think about this because I know a lot of you just like to do the targets and the stops and the swing trades, and this is different. This is putting different systems together. It's like putting pieces of a puzzle together and then they all work together. So you're looking at maybe 8, 9, 10, 12 different systems. I'm going to show you 8 systems today. I've updated corn. I'm updating one symbol each week. We have so many systems here, but I'm actually getting all of this updated. And so you'll see how it looks. It looks fantastic. Okay, so the pairs trades will be replaced with this. So the pairs trades, the purpose of the pairs trade was you're going to lower your volatility if you trade, corn and wheat because one's long and one's short and they go together. But the point is, what if they both need to be long, right? So you can't do that in a pairs trade, but in a portfolio you can. So it's kind of, I think it's a better concept. If you can put together 10, 12, 15 symbols or 10, easily you could put 20 different systems together because each symbol can have 3 different systems. I have double optimized lunar, I have Fed juice, and I have dollar juice. You put all that together, you get a portfolio. So you guys know that we do auto trading here. Auto trading is when you set up an account with a broker and then I will send the signals for you. That's going to be available for the portfolio manager. So if you're interested in that, let me know. And that would be like an auto trading system that is looking at maybe 10, 15 different trading systems together combined. So auto trading is available for that. Send me an email if you want to hear about that. I can send you data or information about it. So if you feel like it's too much for you to trade 3 or 4 different symbols, which I don't think it's that much to do, but if you feel like it is, we can look into doing this with the auto trading. So double optimized lunar cycles are performing very well. Um, so for the most part, they're doing very well, and I'll show you some graphs here. The December newsletters are out, so check it out. If you guys want to check it out, now's the time to check it out. Get a free week to check that out. You get all the double lunar cycles for the month. You can check that out free of charge if you decide not to stay. If you do decide to stay, you'll continue to get that information and updates and videos. The live streams, I'm working on that still working on the chat. The cool thing about this YouTube is that I can chat and interact with you guys. You guys can send me questions or comments and I can write back to you. That's the whole point of a live stream. So once I get that private, we'll have private streams on the website and then I can answer more specific questions. Because on these live streams, when we go live to the world, some people are subscribers, some people are not. So I don't want to give away too much information. Some people have felt like I'm giving too much information on these live streams. So I try to find a balance here. I try to give you guys like an overall view, but the specifics, I'm going to really start holding back a lot on the specifics here and give just broader brushstrokes. So don't worry, if you're a subscriber, you're going to get all the inside scoop tomorrow night, specifically on the S&P. Let me give you a little bit of advice here. This is, the way that we approach the markets, it's not, I don't try to water things down for you guys. I try to give you guys the total picture. So my advice to you is to stick with me, stick around, and you'll get it. You'll start to see the markets the way that we see the markets. You'll start to understand the big picture. So simplifying is good, right? But simplifying material just to be simple is a bad idea. Okay, so I believe in simplification. My whole philosophy based on Bruce Lee's R.G. Kundo. I studied that for years. I went out and met all the original, Bruce Lee family members. I did all that stuff, and my whole focus was on simplification. I'm with you on that. Like that's my philosophy. But sometimes you can't do that. Sometimes you can't simply. You get to a point to where if you start simplifying, things get worse, and you have worse results. So understand that. So I'm not, keep in mind too, my background is also education and teaching. I was a physics instructor for years. My goal is to bring you guys up, not to dumb material down. Okay, because I believe that you guys can expand your thinking and start to see this. Now, I'm not into that whole watering stuff down and trying to make it simple to make it simple and what's the bottom line and all this stuff. I'm trying to give you guys a broader picture and appreciation because I know you guys can do it. I know you guys can come up to this level of thinking of looking at multiple different markets. It's hard. It's hard for me. It's hard for everybody in the beginning when you try to look at, 3 different trading systems and which ones do you follow. And so what I'm saying is I try to focus on expanding the thinking level to be able to hold 2 or more thoughts in your head. Okay. We're in this world of tribal politics where everybody's just got to go to the tribe and whatever the tribe says or the politics says, that's what we got to do. And we got to follow whatever the people say. I'm not into that. I'm into looking at the whole perspective, trying to understand the whole picture. And believe me, when we're talking about the Fed, you have to look at it that way. You can't just simplify the market and down into simple rules or things that had worked before 2009. They don't work now. So My goal is to keep it as simple as possible, but it's not always possible. So just keep that in mind, guys. So stick around. You'll start to. It's just a different way to view it. I think one of the things we can think about as little kids when they get on the phone and they start getting with technology, how quickly they can pick up complex moves. I mean, when I need to fix things on my iPhone, I ask my daughter or my son. He's 6 because they have an open mind. They are able to look at things. When I look at the amount of texting and and surfing and complex technology that goes on in a day, the amount of work that even a little kid does is incredible. So when you guys ask me, how do we do so much here? How do I do so many services? I just look at what the kids are doing. I'm like, man, if they can do it, I can do it, right? So it's just kind of like how I look at this. So I just ask you guys to expand your thinking, keep an open mind, and don't always think that things need to be so simplified. Okay, yes, we need to make decisions with trades, but just simplifying to simplify is not necessarily a good thing. Sometimes we need to look at the bigger picture. Okay, so streaming RSI snapshots. So this is what I wanted to talk to you about. So I have these posted now. So instead of the closing bell, I post this, a snapshot of this on the closing. After the closing bell, I post this so you can see what's going on. This is the instrument. This is the trend. This is the class of stock ETF, grains, financials, metals, and it tells you the category. And then it tells you the actual RSI ranking. So the VIXY was at the top of the list here. And then as you go down to the bottom, it tells you, what's going on. This was actually this was a snapshot towards the end of the day, so you can kind of just get an idea there. And then the best RSI, it tells you the overbought or oversold, so it tells you if it's overbought or oversold. So that's a change that you'll see. The closing bell with the grains and the financials, this is what it looks like. So right now you see corn, you see 10-year, and you see the euro dollar. This is available in the gold service. So again, guys, don't get overwhelmed by this. This is a summary. You can see this every day, but you get used to it. You get used to the concept of this. It's important to look at the whole picture. Very, very important. Big runs, just so you know. This is what we have online: S&P, oil, gold, corn, Bitcoin. These are all online right now. These are all trading. Looking into the euro possibly, but these are still offline over here. So just to let you know. When we look at the flows recently in the markets, the flows have been interesting. We've seen a lot of inflows into gold, the bond, the US dollar, and the VIXY. So the volatility is going up, the dollar's going up, the bond's going up, and gold is starting to shore up here. I think this is interesting because when we're dealing with panic situations, the question is where's the money going to go? You start to see these strange dynamics. Like when we saw the jobs report on Friday, it used to be that, well, bad jobs data means good news for the market because the Fed's going to come in. But then the market's like, wait a minute, the Fed's tapering. So what do we do? What? So it's interesting to see. There's all of these going back and forth and turning around, and so what we're starting to see here, I think these are the trends. The inflows are starting to go gold, bond, US dollar, VIX, volatility, outflows, S&P, crypto, oil, Canadian dollar, euro, British pound. So interesting because these guys tend to go together usually. But I think we might be in a special situation right now. But that's just what we're seeing so far. It could change next week. But right now, the crypto they're not going to the crypto. They're going more to gold right now. So portfolio analyzer, for those of you who were not around last week, let me talk to you about this. So what this is a way to look at different profit and loss graphs of different trading systems. So we want to look at different trading systems as a unit, as how do they perform as a whole, so we can look at the detailed statistics of individual symbols or combined signals. This is looking at long and short positions. Currently, no stops or targets. I'm looking into that right now. I'm researching that. But when you have a portfolio that is balanced with, 20 different systems and they're decoupled, they tend to stabilize each other across time. So this trade's small. The diversity is to reduce your risk, and then think of it as a whole thing, as a portfolio. So this is an example. So this is copper, Fed juice, right? And you can see copper starts out weak in the beginning, strong in the end. If you look at silver, silver is kind of the opposite. It starts out strong in the beginning, weak in the end. And if you look at gold, Gold was consistently strong across time with this portfolio. These are individual stocks. This is Fed juice. But if you put them all together, you get a much smoother curve going up across time, and you get less volatility, less drawdown. So this is the idea. So this is what I talk about when I say that I'm going to have multiple trading systems together. Now, this is just 3 different systems. This is just 3. This is just copper, silver, gold, Fed juice only. We can see the statistics here. These are going to be going up probably this weekend on the website. I'll be starting to post these statistics. But you can go through pretty much any statistic that you want to see here, including profit factor, Sharpe ratio, MAR ratio, volatility, average trade, profit and loss, the longs, the shorts. It's all here. These are actual published trades, actual published, documented on Twitter, documented in the newsletter. So this is not a back test. This is what we have given out to subscribers across time. So this is what I mean when I talk about our portfolio. Like, you're just always in on these trades. You're always doing the system, and that's what it is. Now, the double lunar cycle also has some portfolios, but they perform well at different times. So I'm going to show you 3 here, which is going to be the 10-year, or sorry, S&P, Bitcoin in the 10-year. So this is S&P across time. You can see there is volatility into here. Currently, it's in drawdown now. But if you combine it with other systems like Bitcoin here, Bitcoin has drawdown at a different place here, and it goes up. This is the double lunar cycle. By the way, this is available for crypto subscribers. So it's available now if you're a crypto subscriber. These double lunar cycles are posted in the newsletter each month. And then this is the 10-year right here. You can see the 10-year bond going up here. So if you combine all of those together, you get an even smoother looking curve. This is the double lunar cycles for S&P, crypto, and the 10-year note. So the whole point of what we're talking about here is to change the way you're thinking. Don't necessarily just look at it one symbol, one time, one trade, one target, one stop. Look at it, open your mind, expand how you look at things to look at multiple symbols, 3 symbols, 6 symbols. And this is what I'm talking about. Sometimes when you oversimplify, it creates problems. This is actually, to be honest with you, this is actually simplifying the situation by putting multiple systems together. It's actually simplifying the situation because you don't have to really do much thinking here. You're just following what the system does. So the first one was Fed juice. This was the Fed juice across time. And the next one down here was double lunars across time. Those are portfolios. Now, guys, you can do this. I taught for years and years students, okay, in physics, high-level physics, okay, college-level physics, university-level physics, all different levels of physics. You guys can do this, okay? You need to be patient with it. Give yourself some time to do this. This is not anywhere near as difficult as physics. And believe me, guys, this has been a long time in the making to come up with this. All right. So what if you look at a portfolio? I'm going to show you a portfolio now. So this is one that I put together last night. Now, each week I'm going to be putting together more and more portfolios with you guys. So this is a portfolio of 8 different systems. So this is Bitcoin, S&P, 10-year note, double lunar cycle, and then you're going to have Bitcoin, gold, silver, copper, corn, Fed juice. So what? 8 different systems here. Okay, so what does it look like when you put them together? Here's what it looks like. So the more you put these systems together, the smoother the curves get. So notice that the profit curves have been getting much cleaner out here into recent times, and the reason it's getting cleaner is because the technology is getting better. Like, we're getting better at optimizing. I understand different systems, different symbols. These are all like different human beings, believe it or not. These symbols all have different personalities. Gold may optimize different than copper. Copper may optimize different than corn. The 10-year bond is weird. Natural gas is really strange. Oil is in its own world. So all of these optimize differently. So as I get better at optimizing these, the profits start to get better. So that's why it starts to clean up here, because the technology gets better as we get through time. And again, this is going to be available in auto trading. So auto trading is if you don't want to do the trades yourself, it is executed in an account for you. We set it up with a broker or an FCM, and then the trades get executed or through them. I would send the signals and then they just get executed. So you can see what's happening with the trades, and you would see your account in real time if you guys choose to go that route. If not, you can do this with the service. This is all with the trading. All of this is available to people who are subscribers. So keep that in mind. And I really want you to think about this. Keep an open mind too, like because if you look at I don't know if you guys have read these Market Wizards books. There's all these different books about traders, and there's interviews. And the one thing you'll see about traders is that even though there are specific maxims about rules not to break and things like that, every trader does things their own way. People are successful in weird ways. They go against the rules all the time. Sometimes that's just how it is. People are very individual. Traders are very individual. There's many different ways to have success with trading. I'll give you an example. One of the maxims is if you have a position that's in a profit, it should never turn into a loser, right? That's like a maxim, right? I have found with automated trading that that's not true. Like you have to leave the trades alone. You have to got to leave them alone. You can't just be in there interfering all the time. Um, with the fast fed big runs, if I know when the trade's going to end, it's like a trading window. If I feel like it's ending within a few hours or a day and we're way ahead, then I might trail it down. But for the most part, you need to leave these things alone. So, because I have found that sometimes a trade will be in a profit, like you'll be in a trade, it'll be in a profit, and then you'll be here in a trade, and then the profit will start going up, and then don't ever let a profit turn into a loss, right? Well, okay, well, it goes like this, and then it turns around and it takes off the other way. So me personally, when it comes to this automated trading, and comes to this is systematic trading, guys. This is algorithmic trading. We've written I've written all the code for this. I've written all of the software that optimizes this. We've had it rewritten and rebuilt for what we want to do. It's all customized. Okay. My experience is you got to leave them alone. Just leave it alone. Okay. All this hyper management, it gets to be a little bit much. Like, again, sometimes if we are in, let's say that I'll give you one exception. Let's say we're in a trade and it's like we're doing the fast fed trades. Now, sometimes I get in on these and trail. But let's say that I know that the trade is going to end here. With the fast fed, we kind of know when it's going to end. And there's a trade and it's getting up. And then let's say like this is the target here, right? And there's a trade that's getting up near the target and we're running out of time. Like I know that the fast fed, we know when the trade's going to end, right? This is the swing trade system I'm talking about. So, okay, so I know the trade's going to end, and I know this was my entry right here, right? Well, if I know that the trade's going to end soon and we're almost near the target, yes, I will trail the stop up at that point. Okay, I will. I'll check, like if I feel like if it goes up really really fast in a very short period of time on the fast fed, maybe I'll trail it at that point. But in terms of the portfolios, what we're seeing here, the portfolios, you got to leave it alone. And one of the reasons is the concept of a hedge. You guys, you don't know when these things are going to turn around and start being profitable. You just don't know. You can have a trading system that looks like complete garbage, and all of a sudden it turns around and it goes great. I'll show you another example here. Let's look at another example here. Here's one that looks like garbage and takes off. Copper. Look at copper. Looks like garbage for about a year. Looks like trash. And then it just takes off. So you don't know when they're going to take off. So just to let you guys know I'm not into any one way to trade. Like you guys know, I do swing trades here on those big runs. You guys know, sometimes I get in, I start tweeting and I start tracking or trailing the stops. We have the easy timer, which is really tight stops and targets. I'm into different. I have an open mind, and that's what I'm trying to ask you guys to have, is have an open mind. Don't think that there's just one way. What is the point of what you're doing? Like, what is your intent? Okay, like, and I'm serious. Like, I'm not. This is not just a rhetorical question, but like, what is your goal? What's your goal? And so, you know, here's why I ask this. there's some people that just like the thrill of gambling. Like they go to the horse track, they go to the casinos, and there's a lot of those people in trading. And there's some really, really lucky people. I mean, crazy. Just like in school, like when I used to teach, there's some really, really gifted students that they walk in the room and you're like, wow, like how did you do that? Like, those people exist, right? And there are people that exist that um, are really, really lucky, right? But is your goal just to be in the action? Is that your goal? I mean, for some people, that's what it is. I just want to be part of the action. Or do you want to be a trader, right? What is that? I don't know what that means. Like I'm serious. Like I don't know what that means. Or do you want to make money? Like my goal is to make money with the least amount of volatility and the highest amount of stability, right? What's your goal? I don't think a lot of people know. I mean, I'm just saying like it's a thought process, something I have to think about all the time too, because you get wrapped up in all of these different rules about here's what a trader should be, here's what a trader should do, and you look at it and you look at the market wizards and all of these famous hedge fund managers, they're all doing different stuff. They're all doing different. Some of these people are shorting into uptrends and never short a dull market, and they're shorting dull markets, and they're doing all this crazy stuff that you're not supposed to do, right? So what I'm saying is, what is your goal? I mean, seriously, like what is your goal? And so there's many different ways to achieve that. We don't just have to have one set of rules. Like think about just the concept of the micro contract changed everything. Okay, the micro contract changed everything because now you can get little bite-sized pieces of the market that you couldn't do before, right? This is a micro contract. These are, this is $85,000 on a micro contract, on micro contracts, 8 micro contracts. That's what this is. Okay, so if you're a trader that traded before the micro contracts, you might have all these different rules. You got to have this stop here. It's got to be super tight. It's got to be fixed. And now all of a sudden the micro contracts come out. Well, now if it's 1/10 of the risk, when you're talking about a 10-point drawdown, now you can handle a 100-point drawdown, right? So everything's changed. You got to be able to change with the times. And one of the things is the Fed too. So everything that I do here with our service is based upon micro contracts. So you can create a portfolio, a long, short portfolio. And so you don't have the huge swings that you have with a regular contract. And now we can put together 8 different micro contracts here. Once I get 10 of these, that equals 1 regular contract, right? So think about that for a second. You took 10 micro contracts and you have the risk now, you have the risk profile of 1 contract, but you have the diversity of 10 symbols. That's what you want. That's what I want. That's the goal. Everything that I do here, guys, is for large portfolios. You have to understand this. My background is I'm a CPO and I'm a registered I'm registered to trade. I'm a CTA CPO. I'm registered to trade large funds. So everything that I do here is for large funds. But you can apply this too on the short term. So anyway, so Pinpoint Pattern says down to each trader's appetite for risk. Yes, and so you got to ask yourself that question, too. Like, what is your risk? I mean, there's different ways to measure risk, but what's your risk? What are you willing to risk? Like that's a serious question. And one of the things that, when I talk to people and they tell me whatever their risk is, it's 1/10 of what they tell me. That's the reality. I'm able to risk $10,000. No, you're not. You're able to risk $1,000 before you start freaking out. If they say it's 10,000, it's really 1,000. That's what it is. And the reality of it is that. What is your risk? Are you willing? And then how do you manage your risk? Do you do tight stops? Do you trade micro contracts? That's how I love to do this because I can handle bigger swings. Do you trade micro contracts? Do you trade options? Do you trade ETFs? Do you trade small amounts of ETFs? So there's many different ways to handle risk. It's not just a cut and dry thing. So, multiple symbols, that's handling risk. Diversification, that's handling risk. But I want to get into the concept of diversification with long hedge funds because that's not diversification. And we're going to see that with the Omicron. I'm getting off track here with the portfolio stuff. We're going to get into Omicron in a second. But think about all this. Think about all this. It's not just about you have a certain way that in your mind that you're going to trade, and that's the way it has to be, and that's just what it is, and that's the way that it's always going to be because there's a set of rules and we have to follow the rules. No, there's many different ways to do this. So just think about, I mean, if you trade ETFs, I mean, think about ETFs for a second. You have ETFs, you can trade as one share, trade 10 shares. There's no more commissions. That's reducing risk. You can trade option spreads. You can trade bull call spreads. You can trade bull put spreads. You can trade condors. You can trade butterflies. Personally, I'm not that big of a fan of spreads, but I think out of the money spreads can be good. But if you're dealing with spreads, then you got to think of, well, you got to take the spread off. So then it becomes, well, what broker is best for me? Because if you're going to get charged on both legs of the spread, right? Certain brokers may not be good. Some brokers charge you double. Other brokers like E-Trade and Doe don't charge you to exit off of the spread. That's part of your risk. Which broker are you with? So if you're doing spreads, you probably want to be better off with E-Trade or Doe. Doe was the Think Tasty Trade platform. That's what they do. They just do spreads. That's all that they do. And they're really good at it. Those are the best people to go to if you want to trade spreads. Go to the Tasty Trade, right? But these are all things to think about. So even the broker that you choose can come into the risk concept, right? So just think about that. I'm just brainstorming to keep an open mind, guys. Keep an open mind about what you're doing. It doesn't just have to be one way. You can do this many different ways, and that's where I come at you guys. I'm like, try to keep an open mind, and this is the only way that you can ever come up with innovation. If you're stuck in a certain way of thinking, you're not going to be able to come up with new ideas. All of these concepts I've come up with, guys, these are all original ideas. All of these, you're not going to find this anywhere else. And I do that because the reason we come up with this is because we keep an open mind to what we're doing. We keep an open mind. All right, Omicron effect. We're finally to the part of the presentation. Everybody came. We've been talking about our portfolios the whole time. All right. All right, sorry guys. I'm very passionate about portfolio. Anyways, get a drink here. I'm very passionate about portfolios and creating these. This is really like, I'm really excited about it because we're at a point now to where I think we're really going to take off. Just go to another level here. Okay, Omicron effect. So let's talk about this for a second. People don't realize this, but the infection rates were actually plateauing before Omicron. So you can see here that it's not looking so good. This is the United States. We're still kind of in a plateau here. There was a little jog down, but this is before Omicron. So there was a problem present before Omicron came in. People don't want to look. This is people are so tired of talking about COVID that they don't want to hear it. And then politically, everybody goes to their political camps, and I got to go over here and agree with the blue side, or I got to go over here and agree with the red side, and I can't leave my group, and the whole thing. It's just this is all the way that I look at this stuff is it's addiction. It's addiction, like alcohol, drug. When you get into all this political stuff and people have to go to different political camps, and you turn on the internet and somebody's putting a YouTube video and telling you why you should be outraged, and these people are crazy, and we're the sane people. That's what every YouTube video is, right? It's like, oh, we are just the calm and rational people, and I'm going to show you a video of a crazy person, and then they show the video of the person, and then they're like, but we are the rational and calm people. Everybody does that. They're trying to like make themselves look like but the point is that's all addiction. When you turn on the internet and you start watching these videos, that's addiction. That's the same thing as alcohol. It's the same thing as drugs. The same thing as food. It's all addiction. It's neural pathways in your brain get fired off, and you're like, oh my God, I need to be outraged because I something on YouTube. But objectively, guys, there is a problem here. I have a background in biomedical engineering. This is stuff that I follow. It makes sense to me, though. The whole concept of what's going on with this, it's something that it makes a lot of sense to me. I in addition to physics, I used to teach a biomedical science program. I used to run one. So yeah, this is a real problem, guys. I mean, whatever side you're on, and the Omicron is going to create more problems for sure. Because just because there are some mild cases now, we don't really know enough yet. Were those people vaccinated? What were their ages? And there's all these different factors to come into play here where it could overwhelm some of these hospitals. Like if you look at Michigan's like peak levels. Like Why is that happening? Everybody has different reasons, and if you ask a different person, it's going to pretty much come down to their political belief. They're going to tell you whatever the blue side says or whatever the red side says. Fine. I'm trying to look at this objectively, guys. I'm like the last voice of reason out here in terms of telling you guys straight things in terms of the politics, because I need to look at things straight. When we're talking about financial markets and your portfolios and your accounts, we need to be able to look at things clearly. We can't just run to the camp and do what am I supposed to say because this is what my tribe says to say. It's kind of like, I call that negative IQ thinking. Like, you start getting into that politics, your IQ is dropping down around 80 or 90 because you know exactly what the person's going to say, when they're going to say it, what the response is going to be. And when you get into a situation like that where you know what a person's going to say, they're probably running at an IQ of about 80 or 90. They're just thinking of what response do I say to the next person. There's no thinking going on. And so what I'm trying to get you guys to do is to think about what we're looking at here, okay? So it's a problem. And there was a problem. We're coming into winter indoors. There was a problem before Omicron, and it's going to become a bigger problem. So these pandemics can go for about 5 years. If you go back and look at the Spanish flu, these can go on for a long time. So take it seriously. Take it seriously. Whatever side of the aisle you're on. Okay. So finally, this is going to be, this webinar is getting long, guys. So OMICRON effect. So the confounding variable is the trigger. Okay, so this is the first effect. It's a confounding variable. What does that mean? It's just a trigger for the bear. It's creating this illusion that the Omicron is causing this bear market. That's not what's happening. The Fed internals have been falling. We've been in a bear market since July the 6th. And I've showed you this on many charts before. The Omicron is just making people realize it. This is serving as a trigger for crumbling Fed internals. This is just a trigger. The effect of the Omicron, it's a trigger. It's a confounding variable in statistics. It's something that shows up and we think that that's what it is. That's not what it is. What was the excuse in September? There was no Omicron then when the market started to tank. The only reason the market stopped going down in September is because the Fed came in and stopped it. And remember the big market bluff? I showed you guys that. What was the excuse then? Was it Omicron? It's not Omicron. Like, this market was in trouble long before Omicron. Okay, so keep that in mind. All right, Omicron, the Fed. Here's the next effect here. We are in a completely different situation with the Fed this time. Okay, so do not think that this is going to be the same outcome as before. This is completely different, guys. And remember, I came in March of 2020 and tweeted out, it's still there. You can go look at it, Wolftrader FUTU1. By the way, if you haven't subscribed to that or followed that, go ahead and follow that. Trader FUTU1. You can find that on Twitter. Anyway, at Wolftrader FUTU1. I said in March of 2020, when everyone was talking about the end of the world, I came out and said, no, we're going to rally because I saw what the Fed was doing. But this time it's different. I see what the Fed's doing now. It's different. It's not the same thing. The Fed has to get inflation under control. Okay? So this is a big deal. It has to happen. There's no way around this. They have to get it under control, at least on the short term. Even upon a reversal of Fed policy, a second test of the Fed and the stimulus may not be as successful. So think about this. Even if the Fed turns it around and they start to stimulate again like they did before, and we get into all this emergency lending facilities and all this stuff, it may not be as successful. Don't assume that just because it worked before, it's going to work again. It might work, but with a diminishing return, so keep that in mind. I think people are like, remember, before, nobody thought it was going to work, and I came out and told you guys it was going to work. Very clearly in March, I told you guys that in March of 2020. This time I'm telling you, I'm not so sure it would work a second time around. The public is souring over inflation and modern monetary theory, right? Think about this. We injected all of this trillions or billions of dollars into the economy, and we got higher inflation, and we got, this stagnation in the jobs market. Nobody wants to work. So that the public sentiment might be souring on that. Okay, Omicron effects, divergences. Germany and Australia and Austria were already locking down before Omicron. So let me tell you something. There was already a problem before Omicron. You You guys need to understand this. Some of you want to pretend like there's no problem. There's a problem. The Delta is a problem. Michigan is a problem. Uh, so what do you think is going to happen with Omicron? Lockdowns are going to become more. They're likely to expand. This is another effect that I think we need to start talking about now. Midterm elections might be affected. You might, well, that's far away. It's 11 months. No, there could be mail-in voting. This whole thing could happen again with the mail-in voting. It takes time, the logistics and the prep time to get all this stuff ready. They might start thinking about it now. They're going to have to start thinking about that soon because the whole logistics of this takes months to plan. So you might say, well, the midterms are off in November. Well, if this thing comes and it lasts 6 months, 7, 8 months, that's right into the elections. And then they gotta make contingencies for mail-in voting. So that could be an effect. You may think it's not, but I'm just telling you it could be. Okay, so this is a big one that I think is really interesting, and this is unexpected. The Omicron effect is providing double political cover, and here's what I mean by that. First of all, President Biden, I think this is a positive for him because the markets were going to fall with the Fed no matter what, with the taper. They were going to fall. Like I've been telling you guys this. In September there was no Omicron. It fell. It was going to fall. Now they can say, well, it was Omicron. It wasn't me. It's not our policies. It's Omicron. It provides cover. Provides cover for vaccines to push more vaccines. Because that was part of the plan, the rollout plan or whatever. One of the plans was to vaccinate a certain number of people. So maybe more people get vaccinated, and that's good for the president. That could be like political cover. So and then I would throw in there the concept of a reset too. Like it's just generally it's a reset. Like, oh, market's down. It's not my fault. It's Omicron. So I think that's a positive for Biden. The Fed. This is huge, huge political cover for the Fed. Huge. Markets crashed. It's not us. It was Omicron. Look, if there was no Omicron, the markets crashed. They're going to blame the Fed, right? So now they have the ability to reload. They can start cutting the taper. They can reload all the guns. This is huge for the Fed. This is very positive, right? So they can show everybody that they're non-political, right? Well, we did the taper. We went through with it because remember the Fed's supposed to be non-political. So this is great for them. So they can show that they're non-political. You can throw the hawks a bone. You can say, oh yes, 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 we're gonna cut back. I think the real test would be to see if they're really serious is if they cut back on the mortgage-backed securities because they've caused this housing market to go so high. I think that would be I think we would know at that point if they really stopped the mortgage-backed securities. I think we would know that they were really serious at that point. And then there's another big one: lockdowns and sinking markets tame inflation. That's huge. This is like perfect for them, right? This is perfect for the Fed. So this is unexpected things that I see happening here. But this is political cover. Definitely is political cover for them. I think these are positives for both. Midterms, are there going to be more lockdowns, more mail-in voting? Probably. Or the chances are rising now. Okay. Here's the next Omicron effect. You guys ready? Here's the next one. The Omicron effect is exposing long-only hedge funds. Sorry, guys, I'm getting a drink here. I'm talking away here. It's already almost an hour. We're still going here. I was trying to make these webinars shorter, but we're kind of going off track a little bit today. But I'm trying to make this variety, so each week is something a little bit different for you guys. Omicron effect exposing long-only hedge funds. Let me see if I can get this down, but exposing long-only. So Omicron-fueled volatility deals hedge funds worst monthly return since March of 2020. I look at this and I'm like, we're in 2021. How can people? What? Okay, because I just showed you these portfolios that I'm showing you here. These are long short portfolios. These are trading long and short all the time, right? It doesn't matter what the market does, right? These portfolios trade long and short all the time. But somehow we're in a world where These hedge funds are long only. Okay. I don't understand it. So Omicron effect, exposing long only hedge funds. I guess my question is, why are hedge funds still long bias and only in 2021? Like, how is that even possible? Like, it's like they still make you like, and the answer is because the Fed has bailed them out, guys. The Fed's always bailed them out. How is this even possible that we have long only hedge funds? Like, when I look at electric cars, like, how are we just now starting to do electric cars? That's how I look at it. Like, this stuff should have been going on a long time ago. We're just like we're so far behind on the electric car thing, right? But it's like really they still have long only hedge funds? Yeah, they do. Most of them are long. Why? Because it's easy. Well, first of all, because the Fed has bailed them out, right? So they know that the Fed's going to bail them out. How is like what? How, what? Okay, I don't get it. Like everything that I do is long short, long short. Every portfolio that we build, every trading system that I give you guys, the double lunar cycle, the Fed use, it's always long short, long short, long short, always. Okay? So it's neutral. It's delta neutral. Everything that we have here is delta neutral. So that's again just to show you again here. Now, anybody can show you a profit curve looks like this, right? Oh, I bought Bitcoin or Cardano, or I bought Tesla, or I bought whatever because they were long. Guys, each one of these trades are long, short, long, short, long, short, long, short, long, short. This is delta neutral. Okay. I hope you can appreciate that. It may be hard for you to appreciate that, but I hope you can appreciate that. Okay. But yeah, so let me read to you. Actually, I skipped over a slide here. I'm gonna read this to you. Omicron-fueled market swings appear to have made November the worst month for global hedge fund performance since the virus first shut down economies at the start of the COVID-19 pandemic. Hedge funds are down an estimated 1.6 to 2% in November, according to early data industry research from Pivotal Path, their worst monthly performance since March of 2020. What? Okay, the potential losses are a setback in what so far has been a steady year for performance. Steady year because the Fed has been driving the market up. You got to if I don't understand whatever. Okay, I don't understand this, but I'll keep reading it. The average hedge fund is up 11.4% in the first 10 months of 2021. Data from hedge fund research shows compared to 11.8% last year and 11.9 to 2019. The losses are quite widespread, said Robert Sears, chief investment officer of London-based Capital Generation Partners, which invests in hedge funds. A few of our managers got a little bit of positive performance, but I think in aggregate it's been down. So this is why you got to be delta neutral. Again, what I'm showing you here with this portfolio, this is 8 of our systems here. And I'm going to put more. Each week I'm going to be putting more and more and more. I could probably have about 40 of these things up in a few weeks. And this is all published performance. But this is what I don't understand, how we're in 2021 and people are still in long only funds. I don't care. Look, these are very smart people. The hedge fund, these are some of the smartest people in the world. And you can pick really good companies, but they're all going to go down if the market tanks. So, I mean, even if you pick really good companies, they can't survive a bear market. But the main problem here is that the Fed has bailed. So, is it? It's just kind of it's kind of like it's like game theory, I guess is what it is. Is game theory. Like they're like we're going to go long only because the Fed's going to bail us out. So, okay. It's also difficult to develop long short systems. Guys, doing what I show you guys, what we do here, it's difficult to do. It's not easy, especially to get these things to perform out. Long only funds suffer in bear markets. A long short portfolio has a better chance, and long short portfolios are offered with our Fed use in our lunar cycle. So just keep that in mind that this is the reason why we do what we do. This is the reason why we offer these services to you guys on on all of these Fed uses, long short, from S&P metals, energy, currencies, cryptocurrencies, stock ETFs, all this stuff, long short. Okay. I'm going to go very, very briefly here at the S&P. We're getting a little bit long here. I'm going to be not doing as much detail on the S&P here. I'm going to save the detail more for the update tomorrow for subscribers. There's a big month coming up here, so we know that. And but I just wanted to. So those were some of the Omicron effects that I wanted to kind of go through with you. So just to summarize again, for those of you just joining us, I'm Shane Smoleny from Wolftrader Futures. We are talking today about the Omicron effects on markets and global economies and politics. So I kind of went through what I thought were some effects on Omicron. Um, so if you like the video, give it a thumbs up, subscribe. If you guys want to, I'm not done yet, but I'm just going to show you guys how to reach out if you want to reach out. Shane at wolftraderfutures.com, wolftraderfutures.com. We also have, by the way, I'll put this in here, so www.fedjuice.com. You can reach us there. Twitter at wolftraderfutures, that's what, sorry, YouTube, Wolftrader Futures, that's where you are right now. And then Twitter at wolftrader, FUTU1. I recommend that you go there and follow because we give a lot of updates and notifications. So if you're interested in what we're doing and you like the content, be sure to like, subscribe, and head on over there. And then also on the website, Wolftrader Futures, we have email lists you can sign up there. So, okay, so getting back here into the Omicron concept, I'm going to close here with just a quote. Not going to close, just on the Omicron part here. This is Bill Ackman. He's a very successful, very smart hedge fund manager. But even the smartest people can fall into this trap, which is he believes he made 2.6 billion on the pandemic trades. Says that Omicron could be bullish for stock market. Okay, I got to disagree because of what they saw in 2020. This is getting back to what I was talking about with just assuming that the Fed did it before, they'll do it again. First of all, we're in a different situation. In 2020, I was bullish in March, and again, it's on Twitter if you want to go see it at Wolftrader FUTU1. But I was bullish in March because of what I saw the Fed doing. Because of what I see the Fed doing now, I'm bearish. Okay, so the bottom line is, look, this is the bottom line. It's impossible to rally without the Fed. When there's no Fed, there's no rally. And this has come true over and over and over and over and over and over and over again since 2009. And there hasn't been one case where that's not true. I can't find one exception where that's not true. I look and look and look for cases where to blow holes in that theory. There are none. Like it always eventually the gravity of the situation comes back to what the Fed is doing. So everybody can fall into this trap, even the smartest people, because if you're not focusing on the Fed, market can't do anything without the Fed. So just because you're looking at things fundamentally and you're seeing things from a fundamental standpoint, if there's no Fed there, there's no market. Okay, there's no bull market. There's a market, but it could just sputter around, and best case scenario, right? Okay, so very briefly here, S&P. I'm just going to review what I talked about. This is what I talked about on November 24th. This was Wednesday before the market crashed, and I came on the show. Everybody was bullish. Oh my God, it was like Bull City, Oh, this is the holiday week, and the market never goes down, and how dare you say the market could go down, and we're going to new highs, and tech's going to keep going. And I mean, just the amount of aggression by the bulls on this particular day was it really. I noticed something too. It's not just sentiment; it's aggression. Like people get really aggressive if you if you're near the end of a trend and you say something to go against the trend, people get really upset. The same thing happened in 2020 when it was tanking, and I was like, "No, it's going to rally. We're going to make a full recovery." And they were like, "What?" People got really mad. Like the bears got super, super pissed. I mean, I was getting these just text messages and Skypes in all caps, and how could you think that we're going to rally? And I was like, "Well, look." I try to take the emotion out of this and I try to just look at what's happening. In 2020, I saw the low. Now I see the high. Sorry, that's what it is. So this is what I said. I said this was the evidence. I said that the Fed bluff was over. It was a bluff. The whole October thing was a bluff. The market bluff. The Fed taper is here. It's cumulative effect, and the Fed internals are sinking. And then this was the thing that I said here. And again, I go on record saying this because I want there to be a record. Okay, I don't want to just, you hear a lot of people say in conversations, "Oh, I was bullish at this time. I was bearish in this time. No, here's what it is in black and white. The same thing with my tweet. Clear. This is what I said. Because the price is making a strong negative divergence with the sinking Fed internals, the selling will appear to come out of nowhere. And this was the day before the market collapses. Now, did I know that it was going to collapse on Black Friday? No, I didn't know that, but I knew that it was coming. And I know that when the bear market comes, it's it's um it's unexpected. Like the selling, and because, and believe me, selling, because we're in a bear market, the selling comes swift and decisive. That's what bear markets do. Everyone's like, no, it can't be, it can't be. Yes, it can be. Okay. We're following data. This is the data that we're following here. So this is the Great Market Bluff here. Let me get out of the way here so you can see. Move this up here. No. So there's a taper in progress right now. So this is really bad news for the markets, but this is not a coincidence that as the Fed pulls back, the market pulls back. That's not a coincidence, guys. That's not a coincidence. It always happens since 2009. And I've been telling people about this. I've been telling people until I turn blue in the face. It cannot go anywhere without the Fed. And they're like, no, 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 we're going up, we're going up. And this was right before, this was the holidays here. And it looked, in a minute, makes this just pop up here. And everyone was so convinced we were going to keep, no, man. I have this channel here that I drew. Okay. And it's falling into this channel beautifully. And when it hit the top of this channel after the great Fed market bluff here, I feel very strongly about this stuff, guys. I feel very strongly about this because this is what I follow. There's a taper in progress, and there's probably going to accelerate. And when that accelerates, it's not going to be good for financial markets. They're going to come down. At least they have in the past. So, this is what it is, guys. I'm telling you now. I said it in March of 2020. I was bullish. Now I'm bearish. This stuff can change, though. The Fed could change what they're doing. I mean, they could easily change their policy and pivot. We've seen it before. So we got to be careful about this. This is the one thing that I tell people too. It's not a given that this has to go on forever because the Fed could change what they're doing. And we have to be careful about this. And this is what I talk about focusing just on this weekly information. Like for weeks and weeks, we've been talking about this, but it could change next week. It could change. I don't think it will by next week, but it could. And so we got to keep an open mind to that concept of what's going on. So anyway, so Fed taper, we've talked about this before. It's coming down about 20 billion per month. So it's probably going to be even faster than this. So they have this down around 6:30 ending. But look, this could end as early as April or May if they accelerate this. So none of this is good news for the market. So I know it's hard for people to hear and believe this, that how could the markets rise and fall based upon what the central banks are doing, but that's what they do since 2009. Bank relative strength is getting weak here. So you can see the relative strength of the banks. This is S&P here. This is JP Morgan. Let me see if I could zoom this down. You can see it. Relative strength of the banks is still really falling here. This is something that I track. Banks don't like this taper business. It's not good for their business. Remember, they've got a deal. They do better with their lower interest rates. Okay. And this goes to all types of lending vehicles that they have, but it's not good. One final chart here, VIXY. I do want to talk about this. This is one of the symbols that we offer in the stock ETF service. So I've been talking to everybody about this. The Fed use remains in this buy here. And look at this divergence that was forming on the RSI here. You see this here? Big divergence forming here. Big positive divergence, right? So I was telling people this thing's gonna pop. Like you don't get divergences like this for nothing. And what happened? You can see, here we go. Here we go, off to the races here. So you see this VIX volatility here rising. And notice the Fed use never bought it for 1 second. It stays long here. So that's the thing about the Fed use, is that sometimes this Fed use, it's a very smart indicator because it's looking at what the Fed is doing and it's comparing it to the price action of the security. So again, I'll show it to you both ways. So it knows, sometimes it doesn't take the bait. And it can look like something's off, but I leave it alone sometimes, but you can see here. See here is here. Big divergence forming here, right? So this is the VIX volatility. You can see it's falling. it starts to make this rounding bottom here. You can see this huge divergence here in the RSI. This is an RSI of 5. Huge divergence here, turning up, and then you can see here, boom, there we go. So it came to fruition, and Fed juice now is continuing higher now. It's actually continuing higher. So this is just an example, but those were some of the things that I wanted to go over. So I'm going to do a few questions and answers here on the slides. If you guys have some questions, you can ask them here in the chat. For those of you just joining us, I'm Shane Smoleny from Wolftrader Futures, and we are talking about the Omicron effect today. Yes, Omicron, the new variant that's sweeping the world. We're talking about different effects that it could have on politics, the economies, the markets, the fact that it's really just a confounding variable. It's just, the market was going to go down either way, but this gives people an excuse. And I think what could end up happening too is that, you could end up seeing a situation where the Omicron could actually be very mild, right? It could be. And then you could have headlines, something like, how could such a mild virus take down the markets? And that's because it's not Omicron, it's the Fed juice. It's the Fed juice. Okay, so this is the central thesis of what we do. Guys, I have a US trademark on the Fed juice. I believe in this from start to finish, from top to bottom. Everything that we do is based upon this Fed juice. Even back here into, like I said, even getting into other symbols like the VIX like this, the Fed juice remained in this buy the whole time, and we knew this was coming based upon the Fed juice. So this is not a surprise, but just hopefully that gives you a little bit of a background. I know we covered a lot of information today. We talked about portfolios and risk management and putting together different systems all the way to Omicron now, but I'm going to answer a few questions here that people wrote to me this week, and then if you want to put some questions in the chat, go ahead. This is a question that I got. Hopefully I answered it already, but I'm going to answer this. Will Omicron cause a bear market? This is what people asked me this week. So here's my response, and it's kind of goes in line with what I just told you guys. The bear market started on July the 6th, 2021, when the Fed began to pull back on the internals. Omicron is just a trigger and a confounding variable. When there was no Omicron in September, October, when the market fell, the Fed had to rescue the markets with the bluff. So just to kind of go back here, there was no Omicron back here, guys. Where was the Omicron back here? Where's the Omicron? There's nothing. The Fed had to come in and rescue the markets. Has nothing to do with Omicron. I mean, Omicron is a nice story, or a bearish story, but that's not what it is. What if Omicron is very mild? Will the stock market rally back? This is a question people ask me all the time. They say, well, what if it turns out to be nothing? Oh, it could turn out to be mild. But my response is, the stock market will only rally back if the Fed reverses course on the taper, period. Keep in mind, guys, we haven't just been in a cycle of heightened liquidity in terms of low interest rates. The Fed has been buying the bond market. We've been in quantitative easing, QE. Like that happened during 2008. Why are we still in QE at this point? All-time record highs. Why are we still in QE? Because the Fed knows something's wrong. This market is not as strong as it looks. This is not likely to occur soon. So I don't think this is going to happen soon. But I will keep you guys posted. Remember, for a while we've just been into this down mode, but this can change. We can get into periods where you get long and short alternations on a shorter time period. So this is why I talked to you guys about be careful, because we could pivot and go long at some point on a short-term basis, on a short-term forecast. How do you get notified of the webinars? Question I get asked all the time. So go ahead and subscribe to this YouTube channel. Click the bell, and it notifies you. So the minute that I put a webinar on and I'm like, hey, here's a webinar, it tells you there's a webinar, and then it also tells you the time. Twitter, I highly recommend you guys go here, follow on this Twitter feed. It tells you updates. I post charts, I post sample trades that we're doing. I tell you when we're on radio shows, when we're making appearances, when we have all this stuff is here. Email list is a free email list at wolftraderfutures.com. And then the S&P closing bell, I do put the webinar link there so you guys can check that out. That's posted on Fridays. So this is on Friday. So check that out. How do you sign up for the 7-day trial? Well, you set up an account on the website first. and then you go to price plans page and you can sign up for a 7-day trial on any service. So you can go there, try it out, and there's no charge. So it's not like you get refunded. So this is a question I get all the time. Will I get refunded? So you guys see that all the time. No, money back guarantee. Guys, you never get charged in the first place on a 7-day trial. You never get charged. If you want to try it out, just try it out. If you don't want to do it, fine. Keep the newsletter for a month. That's what it is. If there's any issues, PayPal can refund it. So let me tell you something. People don't like two things. They don't like Twitter and they don't like PayPal. I don't know why. I mean, I know why. I guess big tech. People don't trust big tech. Let me tell you something. Twitter, well, the Twitter feed, you don't have to put your name on the Platinum service. It's a private Twitter feed. On PayPal, let me tell you something. PayPal's pretty awesome. From my standpoint, I can manage funds and control things, and if I have to refund things, it's really really nice. So give it a chance. If you have a PayPal account, you probably have to set up a different profile to sign up for the newsletter. But check it out, man. I mean, check it out. I think you will find it's worth your time. And as you watch these videos, you will start to see it. You'll start to see what we see. Understand the market from a broader perspective instead of just trying to, everybody's got their own personal habits and ways that they like to trade, and that's fine. That's what makes everybody different. That's what makes me different than you. But always be open to looking at markets from different ways. Okay. With all these indicators, where do you start? I would say the double lunar cycle is a really good place to start. But now that we will have these combined portfolios, you can combine the best systems together. And so, for example, for those of you who are just joining us late, I showed a portfolio here. This is 8 different trading systems trading on a micro contracts. So a micro contract is 1/10 of the risk of a regular contract. Okay, so it's 1/10 the size. So what I've done is I've taken micro contracts here, Bitcoin, S&P, gold, silver, corn, note. I've put them together into a portfolio so you can see how the portfolio does together. Okay, so the whole concept of this is to take tiny positions, put them together into a portfolio that will perform. So 1/10 of the risk, you're not even at one contract here in terms of regular futures. So that's what that's all about. Okay, getting back here. I know this is getting long, guys. I'm almost about to wrap this up. Double lunar cycle, you can find it on the monthly newsletter. So if you guys get the monthly newsletter, it's in the monthly newsletter. It's also on the website. So if you are in a service like Stock ETF, it's in the Stock actually it's in the Stock ETF homepage. So I'm adding these for the Stock ETFs too. So you can go to the Stock ETF homepage and you can see the different cycles for the month. Daily charts. If you look at a daily chart, you'll see a double lunar cycle on the daily chart. So they're green arrows on the chart. So there's the green arrows. Or the gold member section. If you go to the gold member section, you can see all of the double lunar cycles posted there for you to look at. Fed use is found on the closing bell daily. It's also on the daily charts. So I would put there too. It's on the daily charts. And trade logs, S&P trade logs are here. Oh, S&P trade logs. So double lunar cycle, just so you know. I put it at the end of the newsletter this month. So if you go to the newsletter, give me 1 sec. We're about to wrap this up, guys. Let me just show people where this is. So if you go to the end of the S&P newsletter for the month, S&P newsletter this month. So I'm going to show you this. So this is the end of the S&P newsletter. You can see here. So this is the appendix here. This is like, I had the eclipses there. So you can see at the end of each month, I'm going to put this here so you can see how it's performing. But this is the S&P double lunar cycle. So at the end of each month, the idea is that in each newsletter, you're going to be able to see how these systems are performing in real time. These are all published results, like I said. So that's something that's new. that I've added to the newsletter. So there's always new stuff going on here, but I just wanted you guys to see that. And here was an old question. What about the positive market seasonals? And I just want to talk about that how important that is, how not important that was actually. There are times when the Fed pulls back that the seasonals can fail. This was turned out to be prophetic words. Not so much that I was clairvoyant. I just had looked at, what happened in 2018 when Powell pulled back on the, we had the taper tantrum and all that stuff over the holidays. I knew that was, there was a good chance that was going to happen. So this is why I felt very strongly that we were still in a negative profile. Taper timeline, when will the markets feel it the most? I think that we'll start to feel it the most getting out here into this late December, January period into here. Keep in mind, this is a chokehold that's continuing to choke and choke and choke and choke the market, and it will likely continue. So, yeah. So anyway, okay. So, guys, long webinar. I know we went a little bit off topic here, but I think it's important to understand where I'm coming from, the value that I'm trying to give you guys with these services, the value, the scope and the breadth of what we're doing. I think what we're doing here is important. I think the work that I do is, I think it's the best philosophy to understand the financial markets, to look at the Fed use. I really do, because we're in a modern era now. We're not in the era anymore of, well, the Fed only sets interest rates and the markets follow what, the Fed follows what the markets do. Now we're in an era of, well, the Fed actively participates in markets and actively purchases markets and actively, actually was buys the bonds. This is a totally different phenomenon. So if you guys want to sign up, I highly recommend checking it out. Wolftraderfutures.com/pricing plans. You can head on over there for your 7-day trial. You can reach me at Shane@wolftraderfutures.com, fedjuice.com, YouTube, Wolftrader Futures, and Twitter @WolftraderFUTU1. So if there are any questions, go ahead and ask it in the chat now. And if not, we're going to sign out pretty quickly here. But thank you so much for coming. I really appreciate everybody attending. Just a couple of reminders again. So Monday, I'm going to be on Larry Pesavento's Trade What You See at 11 o'clock a.m., probably a little bit later, like 11:30 or something. Next week, we're going to have the webinar on a different day, Sunday, probably 1 o'clock. I'll get back with you guys on that. I'll let you guys know. I'll post it on Twitter. And then the following week, there's no webinar. And then hopefully we get back to our schedule. I know we're moving into the holidays here, but I'm going to try to keep these webinars fresh and the variety different each week. And so the more that you guys interact, the better it becomes. So if you guys want to see different features added to the service, or if there's anything that you would like to see changed, or let me know your input, and I will try to accommodate the best that I can. All right, guys. So thank you so much for coming by. I hope everyone has a great weekend. And